for the Word on Wall Street. Top investors watching your money. Joining me right now is the University of Akron Endowment Fund Chairman, Dennis Gartman, Payne Capital Management President, Ryan Payne, and Walser Wealth Management President, Rebecca Walser. Great to see everybody this morning. Thank you so much for being here on a busy day. Rebecca, kicking things off with you as markets are reacting to the growing tensions between Russia and Ukraine. Your thoughts on the impact here? Markets seem to have come off of the lows because the president of Ukraine said he is not expecting a war with Russia, despite the fact that Putin has moved troops into two breakaway regions of Ukraine. Your thoughts on the geopolitical tensions and its impact on an already volatile market, Rebecca?
Yeah, Maria, I would say that normally we'd have a really red day, but lately we've had red days that turn into green days. So I don't know exactly what's going to happen today. But obviously the market never likes uncertainty. And this is uncertainty, right? So we have Russia moving in peacekeeping troops into these two breakaway, supposedly, regions. But the Ukrainian president has been very clear since the beginning. He is not worried about a Russian invasion. And obviously we had the Russian ambassador over the weekend saying to the United States, saying that Putin is not invading Russia. So they're trying to send out messages that they're not invading. Hopefully the markets will heed that and take that. And hopefully that's the truth, Maria, because literally Russian conflict that America has already clearly said would be something that we'd have to involve ourselves in, even though the Ukraine's not a part of NATO. The markets do not like war initially. I mean, it's good for defense contractors. It's good for a lot of those companies. But markets don't like uncertainty. And certainly, this is not Afghanistan. This is not Iraq. This is a world superpower that has massive nuclear arsenal. So this is not the same as anything else that we just beat the war drums to and just jump into a conflict. I think the market needs to take its breath. And, I am leery of this period of time. I'm sensing, Maria, a big shift in the market for now. And so I am temporarily definitely taking some profits and looking to gold to get us through these uncertain times.
All right, so get out of the way. Don't buy stocks here. Load up on gold until the dust settles. Is that your play right here?
That is exactly the play, Maria. Absolutely.
All right, because you look at the price of oil, Ryan, oil prices are back up to $94 a barrel. Brent crude oil hovering around $98 a barrel. Brent hit $99 earlier, the highest since 2014. I know that you believe oil supply is not growing fast enough to drive prices, and OPEC's inability to boost production partially to blame. Your thoughts on the energy space as we look at Macy's stock, which is soaring this morning. The relationship between oil and the consumer is critical here. Macy's is soaring this morning on a better than expected quarter, but I'm wondering if you want to be in retail while you've got Brent crude at $98 a barrel, Ryan.
Well, yeah, I think there's two things going on here. Number one, you have the consumer who's very strong, and I think that will continue. But when it comes to oil prices, and obviously right now, oil is being exacerbated by this whole Russian-Ukrainian conflict. But if you look at the longer tailwinds behind oil, I mean, peak oil demand is still 10 years away. And that's never changed, by the way. Even when we talked about being less oil dependent, we saw that we're not allowed to drill on federal land anymore, and the Biden administration got very, very strict with regulations. We knew that we're going to be dependent on oil for a very, very long time. Now we're paying the price for that, because now if you look at U.S. producers, they're very, very cautious with their balance sheet. They're just not going to ramp up production. In fact, production is still 10% below it was before the pandemic. Meanwhile, the economy is not even fully reopened, right? We still don't have full air travel yet. I'm here in New York City. Every building is still vacant, so occupancy rates are still down. So energy dependence or energy demand is going to continue to go higher. Now, the other point I'll make here is oil prices are like your favorite ride, a great adventure, right? They're so volatile. I mean, we were literally at $60 a barrel oil only a couple months ago. I remember being on here talking with Dennis Gartman about that. So I think you could see some retrenchment here in oil prices, but the longer term is energy stocks look very, very attractive here. They're cheap. Oil prices are probably going to go higher longer term. And to your point, that's going to be a big tax on the economy, because everything we do involves oil. That's going to keep inflation higher. So it's something we got to watch here. But I think, the bottom line is oil prices are probably going higher here, Maria.
Yeah, look, I believe President Biden is authorizing sanctions on the breakaway regions, but will that be enough, Dennis? We just heard from Macy's and Home Depot, both beating expectations. The consumers continues to show a solid balance sheet, but I know you've been bearish on equities. Do you still want to be on the sidelines, or do you want to look for opportunities here? Your thoughts, Dennis?
I think it's far too early, Maria. It's far too early to look for opportunities. I think you still need to be on the sidelines. And this is a bear market. The bear market began January 5th. They always begin technically first. The fundamentals follow later. The fundamental that is going to be driving the market is not really what's going on in Ukraine and Russia. It's the fact that the Federal Reserve Bank is going to become demonstrably less easy. It's actually going to begin tightening in March. It has no choice but to do so because of inflation. And it has been the Fed's expansionary policy that has driven stock prices higher. They're clearly going to become less expansionary. They're going to become somewhat contractionary, and that's going to be deleterious to stock prices. So he or she, as I've said for weeks, in a bear market, he or she who loses the least amount of money will be the winner. And as the chairman of the University of Akron's endowment, I actually had us move 10% of our funds out of the market at the end of December. We moved 3% of our funds last February into gold. And I wish I had done even more than that. For myself, I've reduced the amount of exposure that I have by almost 50%. And I'm still long a little bit, but I'm down about 2% for the year, which beats the S&P, which I think is, as of this morning, was down almost 10% for the year to date thus far. So again, he or she who loses the least shall be the winner, and that's the circumstance that prevails at this point.
Yeah, I'll tell you, the charts on gold look really good. You're talking about a close to a 9-month high on the price of gold in the middle of all of this worry on the global stage. We'll keep watching that. Dennis Gartman, Rebecca Walser, great to see you both. Please come back soon. Thank you so much. Ryan Payne, we're so happy you're sticking with us all morning. Don't move a moment. We will take a short break and come back with much more. Crime is surging across